Good morning, everyone. Welcome to our first Phillip Securities Research morning call for the year. Uh, yeah, on behalf of my team, I just like to wish everyone a very happy New Year ahead. Have a good, blessed, and healthy as well as prosperous New Year. For today, we'll be going through our Singapore's 2025 equity strategy, a summary of it, which was held last Saturday. As for technical analysis, we have it for S&P 500. And also a side note, Paul is on leave today. So do feel free to leave your questions in the Q&A later. We'll try our best to answer to the best of our ability. However, if we cannot answer it, I think we'll pass the question to him and he can take over it on the P3 app. Yeah. Thanks. So I'll move on. The next one, yeah, this is our usual disclaimer. The information provided is solely for educational purposes and should not be considered as a financial advice. Going on to the technical analysis for S&P 500. Currently, in terms of the chart, we are still in a bit of a consolidation going on since November. Key thing is that it's still holding this key 5,855 support level, which is very important. So for now, I think we are likely to see some sort of a sideways consolidation going ahead with immediate resistance at 5,970 to 6,050 area, or support is at 5,830 to 5,920 area. Okay, moving on to our equity strategy summary. I'll hand over time to Glenn to bring us through our three key themes for the year ahead. Yeah, thanks.
Hey, thanks, Zin. Yeah. So I think as you heard, Paul is on leave today, so I'll just be covering him on the parts that he presented on. Starting off with the first slide, the next sorry. Yeah. So we have three key themes for this strategy. The first one being lower than expected interest rates. And I think the most important thing is why we think so and the reasons for it. So moving on to the next slide. Yep, so we see that this is where we think that inflation is going to trend. The Federal Reserve looks at this and then decides whether or not to cut the interest rates. And the most important line here would be the red line, which represents the core PCE inflation. And in 2025, we think that the inflation is going to come off. It has been a little bit hot recently, but in the fourth quarter of 2024, but we will believe that this will start to come off in the first quarter of this year as well as into the rest of the year. And I think the main reason is the base effect, because last year in 2024, inflation was exceptionally strong. So when you do a year-on-year comparison, it should be slightly lower. Now, for the next slide we have here, it's that that we are looking at more interest rate cuts globally in 2025. Right? So globally, we see that there will be quite a lot of interest rate cuts, and we put in Australia in this chart as well, because a lot of REITs hold assets in Australia. So Australia hasn't really cut rates at all. Not sure why they haven't done so, but they are the most hawkish in terms of cutting rates, so that could be one of the reasons. And even then, we still do expect Australia to cut rates in this year, and this will be very supportive for the REITs. For Europe, it has been the most aggressive, and we think again in 2025 they will cut another 4 times. And we focus on Europe also because we have a buy call on Cromwell, which is assets in Europe. So the message here is basically that globally there are still going to be a lot of rate cuts coming, except maybe for Japan, which just does their own thing, and they do the inverse of the other countries. Yep. So now going on to the next slide, we have the banking sector. Yep. So we'll just be touching on a bit of the banking sector and how really that this lower than expected interest rates will be beneficial for them. So just a quick recap on the third quarter results. We can see that the two figures that have really helped the banks contribute to their earnings is the net fees and commissions as well as trading income. So fees and commissions have been quite spectacular for the banks. We've seen it increase quite well, and this has benefited them in the third quarter. For trading income, it was also quite good because in the third quarter, if you remember, there was the yen carry trade, which helped to boost the volatility and also the bank's trading income. And overall, if you look at the earnings, it all grew by almost double digits across the board for all three banks. If you look at the bottom right corner here, bring your attention to the Common Equity Tier 1. So that is the sort of, it shows us how much excess capital the banks have. UOB did see this huge jump up, mainly due to the new Basel IV requirements, whereas the other two banks saw more subtle increases to their Common Equity Tier 1. So that's quite good for UOB, which also sort of explains why they did quite well in terms of their share price the last couple of months. Now moving on to the next slide. Yeah, the next slide, please. Yeah, so the banks have had this very stellar 2024 performance. DBS performed the best, it was up 45%. If you count in dividends, it's almost 51% kind of increase for 2024, which is quite unheard of. OCBC and UOB were also not too shabby, they were up 30%. If you count in dividends, maybe 35% kind of performance for these two banks. So it's really quite a spectacular performance for all three banks. And then this, explanation for the share price performance was from a set of reasons, right? Five of them. First one being the strong set of earnings. Second is, fee income recovery. And the third is that their NIM and net interest income decline was lower than expected. And their fourth one is that their capital ratios were extremely healthy and, resulted in quite strong dividend yields. And last but not least, the lowered rate cut expectations. Now moving on to the next slide. Yep. So for the net interest income, it did go up despite their net interest margins being flat and interest rates going down. So that was a bit of a surprise, and it was better than expected. Usually with a bank, you expect that once the interest rates go down, net interest margins will go down, and also net interest income will go down. But with Singapore banks, why it's slightly different? They are able to because they do have a lot of excess deposits, right? So they will be able to take these excess deposits and put it back into higher interest yielding earning assets instead of putting it to loans, which loans haven't been doing that well. So they put this money back into interest earning assets, which help to boost up their net interest income, whereas NIM is just remains quite flat. So that's one of the why the Singapore banks actually outperform is because their net interest income did better than expected. Now moving on to the next one, the next slide here we have is the fee income. So the fee income has continued to surge. This is also one of the key factors as to why the banks did well. They have reached a record high for all three banks. And I think more importantly, we look at the margin. So their margin over AUM or assets under management has also risen. So margin being that, how much money they earn from the AUM is we basically do a very back of the envelope calculation where we take fee income over AUM, and that's how we get the margin. So if you look at this, the orange bar here, it crashed quite badly. In the middle of in the start of last year. It was really due to the high rates as well as high interest fixed deposits that all the banks were offering. Hence, investors and customers were really just putting their money into FDs, which really have very little margins for the banks. They don't earn a lot from that. Hence, we saw their fee income dipping while their AUM did go up, right? So that's a bit of contradictory because AUM went up, but fee income went down. What we're seeing recently and what we're going to see in the next few quarters at least is that their AUM will continue to increase due to the vibrant capital market activities, but also that their margins will increase because the customers are putting it more. The investor sentiment has shifted and they're putting it more into higher margin products like investment products and bancassurance kind of things. Yeah, so we believe that this will continue to increase going into the rest of the year. Now moving on to the next slide. Yeah, for the loans growth, if we have seen a very healthy recovery in loans growth, even though rates haven't really been slashed. So they are still quite high, relatively high, but loans growth has improved quite a bit. Yeah, we are seeing, I think as of November 2024, it was at a 26-month high of 3.3%. Yeah, I think for the segments wise, we are looking at the building and construction segment being the strongest recovery. Housing loans has always been healthy. They're always at a low sort of single digit kind of growth for housing loans, but we could expect it to further improve coming into this year, with some more new launches as well, as the housing market being stronger. But however, the manufacturing segment has been quite lackluster, so that we could hope that it will improve slightly better, and then this will continue to boost their loans growth. Now moving on to the next slide I have, which is the last slide for the banking sector at least. It's the CET1 or Common Equity Tier 1 and the dividend yield. So, the banks have indicated at this active management of excess capital, right? Because CET1 is at an all-time high with excess capital of around 2 to 4 billion for the banks. What does this mean is that the banks have this 2 to 4 billion which they have to spend and how they're doing it, it's like what DBS and UOB have mentioned that they'll be giving share buybacks. DBS has said around 3 billion, but no timeline. UOB hasn't mentioned any amount or timeline yet, right? So this is quite good for investors and shareholders because they could see a higher ROE and EPS for the banks. And I think for the other banks, they could also do increased dividend yield, which is another form of way of giving back to the investors and to spend their excess capital as well. Yeah, so that's for the banking sector. I'll now go to my stock picks. We have we chose two of the banks as our stock picks. We try to find banks, at least our stock picks that are differentiate them from the other three banks. So I won't be talking on fee income, loans growth, because that's standard across the banks. So for OCBC, what we feel how it differentiates from the other two banks is that basically they have an excess capital of 4 billion and that their CET1 is the highest at 15.6%. So that points to excess capital of $4 billion. If you look at what they've mentioned in the last few quarters of their optimal CET1 being 14%. So we just take the difference, and that's how we calculate this excess capital. And it's the highest amongst the three banks. So we do see some excess equity per share of 89 cents. And if you look at their past dividend or DPS history, 89 cents, I think it's more than what they have given out in the full year of FY23. So they have almost like they could increase their dividends by 100%, and they still would be meeting their optimal CET1. So that's why we see some upside surprise in OCBC with a higher DPS possible in their fourth quarter earnings or even in the 2025 in this year. So we do have an accumulate call with a target price of $18.80, and OCBC does have a 5.2% dividend yield currently. The next pick we have in the next slide would be UOB. So for UOB, how they differentiate themselves from the other two banks is that they are really trying very hard to diversify into non-interest income and also into the ASEAN 4 region, so out of Singapore, which predominantly has been their main market, for many, many years, right? So for UOB, they are very well known to be a Singapore kind of SME banking, a bank, right? So, but what's happened recently is that they are able to finally complete, their Citibank acquisitions in the ASEAN region, and it has also what they have said is that it has accelerated their plans to by around 3 to 5 years to shift away from net interest income into this non-interest income. So it could range from anywhere from fee income to cards fees to personal banking, wealth management kind of things. Yeah. Recently, their fee income as a percentage of total income has declined slightly, right? I think that's why they are doing this, sort of acquisitions to try to bring it back up to the levels which they feel that it is appropriate. Yeah. So we believe that this will continue to rise in 2025 as they concentrate more on their non-interest income as well as in these regions where they did not have as much presence previously. We do have an accumulate call with a target price of $39.70, and UOB also has a dividend yield of 5.2%. Yeah, so that's all I have for the banking sector. I'll now hand it over to Darren for the REITs. Thank you.
Hi, everyone. Thanks, Glenn. Yeah, so for the REITs, first of all, the REITs share prices weren't that great in 2024. It was down 6.2%. So basically the REITs, the share prices in 2024 were very volatile. It was largely dependent on the expectations of interest rate cuts. So we saw at the start of the year, end of 2023, the expectations were like 4 or 5 rate cuts, and then as a result, the REITs rallied, and then after that, suddenly the expectations keep switching to fewer rate cuts and more rate cuts, and the REIT share prices just reacted that accordingly. So as a result, after Trump's election, the tone for rate cuts are more hawkish, so fewer rate cuts expected. So as a result, basically the REITs share prices was down as of the end of 2024. Yeah, so this chart shows the S-REITs index price to NAV. Right now it's trading below the COVID-19 lows, so it's 0.86 times. So we think valuations wise is definitely attractive. We've seen property valuations for some of the REITs already start to increase, especially those in Europe, for instance, Cromwell European REIT, which is now known as Stoneweg after Stoneware acquired a stake in the manager as well as bought over Cromwell's stake in the REIT. So we've seen some cap rate compression there with interest rates already coming down in Europe. So ECB, they cut rates by 4 times as last year. So we saw in the mid-year property valuations, Cromwell's portfolio had some slight valuation gains. So like Glenn mentioned earlier, in Australia, they've yet to cut rates. So we do expect some cap rate expansion there as well. So we expect property valuations in Australia to remain weak for this year in valuation exercise for a lot of the REITs with Australia assets. For Singapore, yeah, cap rate remains stable, so we expect property valuations to remain stable as well. Yeah, but with interest rates coming down, we do expect across the board more and more cap rate compression across different more geographies, and as a result, property valuations will start to likely increase 2025, 2026. Yeah, we also noted that recent transactions really picked up, especially post the rate cuts. The more notable ones were the $2 billion transactions of ION, as well as the Capital DC transaction of acquisition of Capital DC 7 and 8. So the valuations were also done mostly at a book or above that book value as well. So even the week at the start of the year, Capital DC announced a divestment of the Malaysia data center. So that's one of their weaker assets. So even so, they also managed to divest at a slight premium to valuation, a 2% premium to valuation. Yeah, so that's a good sign as well. And going forward, we also expect more transactions from the low interest rates. Yeah, next slide, please. Yeah, so this chart shows the forward dividend yield versus the DPU growth yield. So the line is the forward dividend yield for the S-REIT index, and the DPU growth year on year is the shaded area. So forward dividend yield, it just means the dividend yield expected for the REIT. So we see it really increasing over the past few years. But that's mainly because of the share price action. The REITs, the share prices really wasn't that great. So as a result, the dividend yield will increase, and the forward dividend yield it didn't increase because the DPU grew over the past few years. But going forward, we do expect the DPU grow, especially from lower interest rates. So yeah, I have another slide later to explain more on that. But for the DPU growth year on year, the shaded region, that is basically the S-REITs index year on year absolute growth in DPU. So we saw in 2020 was a very weak year. So the DPU was down 5% plus. And in 2021, because of the low base in 2020, it started to recover, 2022 as well. And from the hike in interest rates, we saw REITs really affected their DPU. So as a result, 2023 and 2024, we saw some DPU declines. Yeah, but like I mentioned, we do expect DPU growth in 2025. Yeah, next slide, please. Yeah, so this is a 10-year dividend yield spread. So it follows from the previous slide. So basically, this is the forward dividend yield minus the 10-year Singapore government savings bond yield. So how you can interpret this is how much investors are being compensated for investing in the riskier asset as REITs over the risk-free rate or risk-free bond per se. So we see over the past 2 years is the yield has been increasing, and we do expect this 10-year dividend yield spread to move back towards its 10-year mean, which is the red line, at about 3.7, 3.8%. And that's mainly because of the higher absolute DPU that the REITs will start to pay out from lower interest rates, as well as the fact that with more rate cuts, the 10-year yield on the Singapore government savings bond yield will likely decrease. So its expansion, it will expand both ways, and as a result, we do expect this yield spread to continue improving. So this is an attractive way to compare the REIT's yield with so-called a risk-free rate yield. Yep, next slide, please. Yeah, so this chart is basically our coverage list, and it shows some of the matrices that we monitor. Yeah, so in November 2024, or rather 2 months ago, MAS relaxed the limits of adjusted ICR and gearing. So previously, there was a gearing limit of 45%, but if the ICR is 2.5 times, the REITs could bring their gearing to 50%. So MAS changed this to a fixed adjusted ICR ratio of 1.5 times and gearing at 50%. So this is a slightly relaxed limits. So the immediate impact, we don't think will be very significant to most REITs. But for REITs that are hanging very close to those limits, like Lendlease Global Commercial REIT with adjusted ICR at 1.6 times, and Suntec REIT, yeah, those are we have to monitor closely, more closely. So for Lendlease, now that the ICR is at 1.6 times, and the fact that interest rates are likely to decline, so as a result, the denominator will likely decrease from the adjusted ICR ratio. So as a result, we don't think that the risk of them breaching this 1.5 limit is very high. But in any case, even if they do breach, the consequences are that they cannot take on any more loans to expand, but they still can refinance. So it's something similar to Manulife, where when they first breached their gearing limit, they couldn't take on any more loans. So it's a similar kind of a consequence. Yeah, so that is for ICR. Most REITs are healthy, way above the 1.5 times. And for gearing, the new 50% limit, the one closest is Prime US REIT. So we're also monitoring that. Right now it's at 47.8%. So the management, they also mentioned that they are confident that they will not breach gearing from the asset devaluations because they have to do one year-end asset valuation exercise. And the US office market is still not doing that great. Like we saw Manulife, they divested some one asset capital at a 30% discount to valuation. So all these recent transactions will affect the gearing and property valuations as well. So from our stance, we think there might be a risk. So we are monitoring closely this gearing limit for Prime US REIT. Yeah, so the next column, basically the first three columns, they are all heat mapped. So you can see by how dark the color is. So for the third column, the percentage of loan fixed, Fire's Hospitality Trust looks most promising as their percentage of loan fixed is 40%. So they will likely benefit the fastest from any interest rate cuts. And most of the REITs, their percentage of loans that are already fixed have already been repriced to the current level. So going forward, it's likely that they will experience lower interest costs. Yeah, and the fourth column is there's a perp bond next reset date. So things to take note is that Lendlease and Suntec REIT, they have perps that are expiring this year. So just nice, I saw there's a question from the audience asking, do you include perps in your gearing ratio computation? Yeah, so for gearing, according to the property fund appendix, the perps are not included inside this calculation for gearing. So you have to take note if, let's say, they decide to refinance these perps with classic loans like bank loans or the normal bonds, then definitely the gearing will increase. So these are things to take note. Yeah, but perps, basically they are pseudo equity, so they are not calculated in gearing. But the perps, the perps interest payment is calculated inside the adjusted ICR ratio. Yeah, and on the right column is our PSR recommendation. Yeah, next slide, please. Yeah, so I'll move on to property. So for property, over the past, or rather the first 3 quarters of 2024, we saw about 3,200 new launches. The take-up rate wasn't that great in over the first 3 quarters as well, but the take-up rate and really picked up in the fourth quarter. So in the fourth quarter, there were many launches, 4,000 over launches. And here's on the right, there are some examples that I put there. Everyone of Katong and Norwood Grand had over 80% take-up rate. So the demand mostly from Singaporean and PRs, and the demand basically really picked up after the interest rates were cut. And going forward, we do think that this demand likely will increase with more interest rate cuts on the horizon. And there are also way more launches, 14,000 plus units to be launched in 2025. So we are monitoring the situation to see how strong the demand is. But after all, demand is still only from Singapore and PRs, and because of the 60% ABSD hike back in 2023, so that really evaporated all the foreign buyers, and the launches are also, or rather the high-end take-up rate and luxury projects, all these are not that great as well because of the absence of the high net worth foreigners because of this 60% ABSD. And we also cite a so-called lack of catalysts in the property sector other than the lower interest rates that can help to drive local demand. So yeah, we are still monitoring this property sector, and which is why we still call it neutrals. We need to monitor to see how actually strong the take-up rate going forward will be, especially with this 14,000 new units launched. Yeah, so that's for our property sector. Next slide, please. Yeah, so now move on to our stock picks for the REITs for dividend yield. So for Stoneweg European REIT, which is the new name for Cromwell European REIT, we like them because first of all, they're paying a high yield, a 9% yield, and also they are one of the first few REITs that experience some cap rate compression, and which result we saw some valuation uplift in the first half of the year already, and we're expecting more portfolio valuation increases in this year-end valuation exercise. So this chart I put up here, it shows the DPU. Even though it doesn't look great, the DPU is falling over the past few years, but that's because they've had this divestment exercise where they're taking a proactive stance to divest assets so that they do not breach the gearing limit. Yeah, so that paid dividends as we noted that their gearing it remained around 40% or lower over the course of the past few years, despite the fact that the portfolio has experienced some valuation decreases due to the cap rate expansion over the past few years, barring this year, because this year we saw a little bit of compression already from the low interest rates. So due to the absence of contribution from these divested assets, we saw the DPU really decline a little bit from 17 cents to about 14 cents, our expected full year dividends. And we've already accounted for these external divestments as well as the interest rate impact. And at 14 cents, Stoneweg is paying a 9% yield, which we think is very attractive still. And going forward in 2025, they have a bond to refinance, which is why their interest will increase to 13 cents. But at 13 cents, Stoneweg is still paying an 8% yield. So we think this is an attractive proposition for them. Yep. And their portfolio occupancy also throughout COVID, throughout the Ukraine war and such, it still remained above 94%. So that is also shows the resilience in their portfolio. Yeah, next slide, please. Yeah, so our next pick is CapitaLand Scott Trust. So being a CapitaLand name, having a dividend yield of 7%, we think that's attractive as most other bigger cap names of like the CapitaLand names and the Mapletrees, they are paying a 5 or 6% yield. So at 7%, we think Class is attractive yield play. So operation wise, we do think Class they have a potential for organic and inorganic growth. So for organic growth, we see RevPAR have already reached pre-COVID levels, and going forward, we do expect some low to mid single digit increases in RevPAR as well. And this is for their growth income, and they do have some stable income sources as well from the master leases. So for instance, they also their France master lease last year they renewed the France master lease at a rate that was higher than the 2023's fixed and plus variable rates. So last year they renewed it at a fixed rate, but the fixed rate is last year they renewed at higher than 2023's both fixed and variable. Yeah, and this fixed rate that they renewed at it also includes a CPI indexation. So that is the stable income sources. So that they'll benefit in even if the demand for their property doesn't perform that well, they'll still benefit as they're getting master lease. So that is what I mean by stable income sources. So that is the organic growth part. And for inorganic growth, they have divested some assets in Japan, especially with some solid premium to valuations, and clocking in some divestment gains as well. So they divested about 40% and 50% for two of their Japanese assets, and all the other assets that they divested were also above valuation. And as a result, they still do have about 350 million of previous divestment gains that they've yet to pay out, and they can just use this to top up DPU at their discretion. But for now, they're still holding back, and they did mention that in 2025 they will use some of these previous divestment gains of 350 million to pay off or rather to top up DPU from some of the while some of the assets undergo AEI. As a result, the assets will not contribute when they are doing some renovations there. So they'll use this reassessment gains to top up these assets, or rather the loss of income from these assets. Yeah, so growth both ways, inorganic and organic growth. That's why we like Class, and the fact that they're also trading at 0.8 times price to NAV. So yeah, that is a discount, and that's cheap compared to the historical valuations as well. Yeah, next slide, please. Yeah, so next is CLI. So for CLI, we do expect the FRB business to continue to improve, especially from event-driven fees under the listed platform as well as unlisted platform. So for the listed platform, we saw CICT, they acquired Ion from CLI. So as a result, CLI will get some acquisition fees from CICT from Ion Orchard, and that is quite significant as Ion Orchard is a $1 billion property. And they also do have some other event-driven fees from Escort as well. Yeah, so the event-driven fees will pick up, and the fact that we see CLI's FUM also increased significantly in the fourth quarter of 2024. They acquired Wingate as well as PhillipCapital partners, so that really grew their FUM by 15 billion just in the fourth quarter alone. And if they carry on and continue this track, they will definitely hit, or it's very likely that they will hit their 2028 target of 200 million. Yeah, so basically we like CLI for their asset light and this funds or fee income recurring model. And for China, it still remains weak. It's signs of improvement. There are slight signs of improvement, but we still expect some property valuation losses or asset valuation losses in China. They do have about 3.5 billion of Chinese assets that are still sitting on the books, and they do plan to divest these assets, but the timeline given wasn't so much in the near term. Is a medium term goal to divest and optimize their Chinese portfolio. Yep, and despite all this, CLI is still paying a dividend yield of 4.6%. So we think that is attractive, considering CLI is not really a REIT, but the REIT manager. Or rather the manager of a lot of these REITs, or rather the sponsor of a lot of these REITs. Yeah. So that's all for me. I'll hand over the time to Miao to talk about China. Thanks.
Thanks, Darren. Yeah, so this is a bit contrary, and we're not saying that Chinese economy will have a turnaround in 2025. Next slide, please. Yeah, so since 30% of the GDP is contributed by the property market, and it's just very difficult to fill in the hole. A majority of the policy released by the central government by far are centered around the fiscal stimulus, which is such as lower the reserve requirement ratio and also cutting the main policy interest rate. And the key point is what's really driving the confidence is the central government is ready to back up the economy. We also, the next slide, please. We also believe there are rooms to maneuver over the upcoming tariff, and China won't be so badly affected since the tariff is for everyone, not only China. And another support for China would be Trump's biggest supporter, Elon Musk, which contributed to around 240 million for his latest campaign. Also, we believe he has a deep interest in China's in China market, since Tesla, more than 20% of Tesla's revenue in 2023 was generated in China. And they also have a mega factory in Shanghai. So it will be in his interest to protect China's overall economy. And there's also other ways to get by the potential tariff. Like China did done a deal with the US just pre-COVID. China agreed to purchase more than 200 billion goods and services. Also initiated some IP protection and opening up the financial market. As a result, US in return agreed to cut effective tariff from 15% to 7.5%. However, there are still some potential tail risks we would like to warn investors, such as Patriotic Investment Act. This essentially is US will stop all the investment to China and also withdraw all the existing investment in Chinese firms. Yeah, so this is like a nuclear option investment. No one would be benefited. We don't think this would actually happen. It's just some tail risk we would like to watch out for. Next slide, please. Yeah, so moving on to some counter updates. China Aviation Oil is the largest physical jet fuel purchaser in Asia Pacific region. And profit for sale mainly comes from two parts. Firstly is from its associates. Sale owns 33% of the stake in Shanghai Pudong International Airport. And they are also the sole jet fuel supplier to all the aircraft departure and takeoff in Shanghai Pudong International Airport. Yeah, so they are basically the monopoly here. And Shanghai Pudong International Airport is also the largest international airport in China. And pre-COVID, profit from associates accounted for 70% of the total profit. With the recovery of international flights, especially traffic increased by 76% year-on-year in November 24, and also reaching 94% of the pre-pandemic level, we believe profit from associates would increase at least by 50% year-on-year. Also will increase from 30 million last year to 44 million this year. And apart from profit from associates, sale also supply jet fuel globally. This is essentially a trading business, and sale will be benefited from the contango situation or some geographical mispricing stemming from some geopolitical uncertainties, such as the Red Sea conflict, which will redirect some demand back to the Asian market. And not only we like sale because of its very visible earnings, they also have pretty attractive valuation. Sale currently owns 353 million cash in hand and is making up to almost 50% of its market cap. And we also believe the greatest share price catalyst will be coming from its dividend policy. Sale announced it 5 cents per share last year, which is a combination of special dividend and also ordinary dividend. And we believe with the exceptional earnings this year, payout ratio would increase from 30% last year to 40% this year. Yeah, then translating to 6% dividend yield. Next slide, please. So Zixing is a Chinese sweet potato operator. And there are a lot of things to buy in China. Essentially, we like Zixing is because Chinese government is encouraging food securities by allocating lands and giving subsidies. As a result, we anticipate pet meat to at least triple this year. Yeah, so will be around 34 million RMB. We believe there's like several pet meat catalysts. Firstly is we anticipate sales for fresh sweet potato will double this year with the introduction of cold storage facilities, which will extend shelf life from originally 1 week to more than a month now. This will expand its distribution channel to somewhere such as the supermarket. And Zixing is also actively expanding its revenue stream by converting agricultural waste into animal feed. And so this will translate to around 1.7 million profit next year. And the long-term share price catalyst is coming from the Hainan Rejuvenation Project. This is a joint development with City Construction, and that's the second largest company in China. Upon successful completion, we expect the total cultivable area to increase at least by 5 times. And Zixing will adopt the Euro business model, generating profit by selling sweet potato and processed sweet potato products. Yeah, therefore, we expect pet meat to increase at least by 5 times upon successful completion. The next slide, please. Yes, this is not related to China. It's just another sector we are covering. So air transportation. The chart is about passenger kilometer, which is commonly used as a measurement for airlines capacity. And as shown on the graph, capacity is reaching and also surpassed beyond pre-pandemic level by 7%. Yeah, so we do expect fading recovery tailwind in the industry, along with decreasing load factor and the yield. For 2025, we remain neutral on aviation sector. Well, there is potential for improvement driven by recovery demand from China. Growth is likely to be weighed down by several factors. Firstly is the intensified competition over airfares, as small capacity are entering into the Asian market. And to add pressure further, improved supply chain efficiency, which is bringing more aircraft into the market. Yeah, so this will further intensify the competition. Last but not least, we anticipate weaker business sentiment amid geopolitical uncertainties, especially with Trump's administration. However, airlines are still going to be the top beneficiary of the expected decline in crude oil price in 2025, as the market generally anticipate unwinding OPEC production cut. So lower fuel price, which accounted for more than 30% of the airline's total expenditure, would subsequently support airlines' profitability. Next slide, please. Yeah, so the last counter, because we SaaS, we anticipate FY25 to be an exceptional year for SaaS, with profit mainly driven by its gateway service, particularly the cargo handling side. Cargo momentum sustained in October 24 and increased by 13% year-on-year compared to a contraction of 13% year-on-year pre-pandemic. We believe SaaS is able to capitalize on the expanded market share after acquisition of WFS, and the cargo momentum is likely to sustain at least before the implementation of tariff. Additionally, we like SaaS because of its great pricing power. They have just successfully repriced one of its major customer, SAA. Yeah, so which accounted for 17% of FY24's total revenue. And SaaS reviews contract repricing as an ongoing and also a progressive measurement. And with inflation being a global issue and majority of the contract being indexation linked, we believe there will be more opportunity for SaaS to reprice their customer this year. Yeah, that's all for me. I'll hand over back to Glenn for other stock counter updates. Thank you.
Yep, thanks, Mel. Yep. So the third theme that we have here is the corporate restructuring gains. Yeah, so these are actually Paul's slides in his coverage, but I'll just be covering him because he's on leave. Okay, so now moving on to the next slide. The first one we have here is Keppel. So we do still like Keppel Limited, and we think that they are still riding this data center wave. And there's still, we also believe that there's a very huge demand for data centers in Singapore. And Keppel have also just repriced their rentals for data centers by 40%. Basically, it's just that there's a shortage of data centers and still plenty of demand for data centers. So I think the question being is that how will Keppel benefit from this? But I think the first one is that you need power to run a data center, and we believe that there's going to be a huge amount of power demand in Singapore. So it's not only from data centers, but also from the EV cars that are coming up in Singapore. Power demand for the next 10 years is going to be very strong. I think we saw that power demand in Singapore, why is it going to rise? Is that last year it only grew by 1%, but for the next 10 years we're looking at about a growth of 3 to 5%. Yeah, so Keppel is going to benefit because they do have a power plant, a new power plant. Is the one here on the first line here. The first point is this Keppel Sakra power plant. So not only the demand is going to be strong, but also they have a lot of old power plants that are going to be decommissioned. That's why the power sector is going to be very resilient for the next few years. And the next one is that they're going to be importing power from other countries. It's also going to be able to benefit Keppel. They have built this submarine transmission cable, and the prices have also doubled there. Keppel does also have a fund management side now, and they have a lot of capital to build more from that fund management side. So this will be a good and a big growth driver for Keppel. And I think the next, however, we look at the next near term, we think that the results are not going to be very strong for Keppel because last year they did sell a lot of Chinese land. And of course, last year during that period, nobody was really selling any land in China. So that's why we believe that earnings were a bit softer in the near term. But the key to watch, going into this year will be their asset monetization, which is basically this team. Is that, they do have another 4 to 6 billion over the next 2 years. They also have this 4.3 billion disposal of the rig. And last but not least, they also have NM1 merger. We do have a buy call on Keppel with a target price of $7.60. Now, moving on to the next counter we have, it's Singtel. So Singtel, as the title suggests, it says the monetization of Bharti, InTouch, and property as well. So Singtel, their share price did improve quite well, mainly from, they benefited from their stake in Bharti Airtel. They have around 29% stake. So, it went up to almost reach the market cap of Singtel themselves. So that really helped the Singtel share price move up strongly. But nonetheless, apart from this, we still like Singtel because the yield is attractive, it's around 5%. And they're also on this monetization path. They have almost explicitly mentioned that they would be selling their stake in Bharti, but not their whole stake, maybe just around 1 to 2%, because they're trying to equalize their stake with the other major shareholder. So there will be sales of this stake, and of course, with sales, it comes with special dividends that will be given out to everyone. Another thing that they could be selling is also the InTouch, which has merged with another company called Golf. So they will be selling the Singtel Com Center, related to this. And so all this selling, again, will generate profits, and then they will be giving back dividends to the shareholders. And last but not least, apart from the selling of almost like a lot of things, right? They're also doing quite well in the background, where they are trying to improve what has been an issue for them, which is Australia and particularly Optus. So the return on Optus was only, I think, 1%. And how they're trying to improve this is by doing a lot of cost cutting in Optus, so that they will be so this will definitely benefit Singtel, and also, more importantly, I think it's helped to solve this issue that they're having, and maybe get a better ROI on Optus, which has been sort of their like bane. Yeah, so we do have an accumulate call on Singtel with a target price of $3.44. Now, the next telco, I guess, would be StarHub. So this chart basically just shows the price of mobile prices, right, in Singapore. 2008 and 2000 to 2016, this was the best time to be a telco in Singapore. Where you just sit there and you get your fees will be quite healthy. Although it declined a bit, but it did grow a bit for StarHub. Right, but however, after that golden era, I guess, it sort of declined, when WhatsApp as well as other competition sort of came in. And we thought that during the pandemic, it would help to lift the mobile prices, but it didn't, because of the roaming competition that came in as well. So this is a very problematic chart for any mobile operator, because every year the mobile prices just keeps coming down. We believe that a merger could be happening, and that will be beneficial. So, StarHub's dividend yield is currently very attractive at around 6%. However, just to note that during the merger, it'll be quite painful, because they have to make a lot of cost cutting, also do a lot of write-offs. So I think our advice is not to stay around when the merger does happen. We have a buy call on StarHub with a target price of $1.29, and they also have a very healthy yield of 6%, as I mentioned earlier. Now, moving on to the next one, we have it's Thai Bev. So Thai Beverage, they sell alcohol, basically. They sell spirits, and most of their profits, around 80%, comes from selling brown spirits. And they do have this monopoly in Thailand. They state, officially there is only a 95% sort of market share, but it could be 99%. Nobody really knows. So I think it's really quite a big monopoly that they have in Thailand. But even then, their valuations have been steadily creeping down, right? And one thing that they could help them sort of improve the share price as well as their valuations is the beer co stake sale, which we are looking at of around 2.2 billion Sing dollars, and this could help raise the share price for Thai Bev. Now, moving on to the next slide, we have we don't really have coverage on this. It's more we just add this in because we believe that this also falls under the theme of asset monetization. Firstly, we have Olam. So Olam's market cap is at 4.6 billion. And then they'll have firstly the Olam Agri IPO sale, they're looking is worth around 3 billion. But however, just to put it out there that we are unclear of the debt that this segment has. And also, their Olam Food Ingredient IPO is, I think, around the market cap is the same as Olam itself, for around 4.4 billion, right? So these two will help quite well. But one of the biggest worries, I guess, is that they have very high finance costs, right? They have extremely high gearing. I think their finance cost annualized is around 1.6 billion. You'll be asking, how can such a company have such high finance costs? Maybe I think the main reason is because they are backed by a sovereign wealth fund, whereas the other competitors aren't, so they can't really get away with this kind of high finance cost. Yeah. The next one, which I think will have quite a few questions, would be SingPost. So, SingPost, they have a 1.2 billion market cap. I think the two sort of ways that they can have asset monetization will be the first one will be the disposal of their Australian assets of around 900 million Sing dollars. And of course, their SingPost Center, which is almost equivalent to their market cap, 1.1 billion. Yeah. So, but the issue with SingPost is that once they do sell these assets, they will give a special dividend, maybe 10, 20 cents per share. But once they do that, the share price will also drop by the same amount. So, it's really net. If you look at it, it's the same. It's the same, right? You're left with not much of a positive. But we have to. I think the important thing is that the restructuring. So they are looking to do all this selling. Is mainly to restructure Singapore Postal, right? In general. So this, especially the post office. So it's been in the news recently. I think this will be good because after restructuring the company, I mean, they restructure to benefit the company. So that will be one of the positives. But I don't think it'll be happening anytime soon. So probably not near term kind of view. We're looking at medium to long term kind of restructuring. So that's for SingPost. Now moving on to our Absolute 10 model portfolio. Yeah, the next slide. Yeah, next slide, please. Thanks. Yeah. Yeah, so for the model portfolio, I think that we do have a lot of banks now. So we added in OCBC together with UOB. They were the main upside surprise. So that we could see the main surprise, and also we could see more of a surprise in the fourth quarter, mainly due to the higher dividends as well as share buybacks that they could be doing, which would improve the ROE as well as EPS. Apart from that, I think we have also added in WeHer, which my colleague Iqban will cover on later. Yeah, so that's all I have for this. I'll hand it over to Iqban for the rest. Thank you.
Thanks, Glenn. Now I'll be talking about construction and also WeHer, which we just initiated. So this is a chart about the trailing 12 months of construction contracts being awarded. The dark blue line shows the contracts being awarded, and the red line shows the payments which come after, which means when the revenue and profits will be realized by construction companies itself. So as you can see, the blue line currently is at record levels because construction itself has significant demand from both public and private sectors. For public sectors, the demand mainly comes from Changi Airport Terminal 5, which will undergo construction this year, as well as the various BTO projects that has been ramping up ever since the COVID backlogs has declined. As for private sectors, the demand mainly comes from the expansion of the integrated resorts. So hence, as you can see in the chart itself, the dark blue line generally leads the red color line. So when the dark blue line goes up, after 12 to 18 months, the red color line will follow. And also vice versa, when the dark blue line comes down, the red color line will generally come down as well for most of the time. So we do think that because of this, of the dark blue line being at record levels, we do think that the red line will also follow trend up. And this will mean that construction companies can realize additional revenue and profits because of this elevated construction contracts being awarded. And another thing to note is that BCA, the Building and Construction Authority, also forecasted that construction levels will be between $31 to $38 billion annually from FY25 to FY28 for the next 3 to 4 years. So taking the average levels of around 34.5 and 35, right? This is shown by the light blue color horizontal line. So as you can see, this light blue color line is above average levels pre-pandemic. So we do think that we are quite optimistic about construction as a entire industry, because the whole construction levels is projected to remain at elevated levels. Yeah. Next slide, please. So now I'll be covering WeHer. We recently initiated coverage on WeHer, and the title in this slide is called Unlocking Value from PBSA Sale, because that is also the title of our report. So as you can see, from the first half 2024 revenue, WeHer has many different segments. So the bigger segments come from building construction, which has a 41% revenue contribution. So in this segment itself, building construction, they take in construction projects from residential, industrial, and commercial projects. And we do think that there is tailwind because of the construction demand, as mentioned in the previous slide. However, management did anticipate tenders to be competitive. So we are not super optimistic for this segment itself. We are just like neutral for this segment. For workers, dormitory segment itself, they build and operate worker dormitories. And currently they are operating Tuas View Dormitory, which has around 16,000 beds. And this year itself, they will have a new worker dormitory called Pioneer Lodge, which has around 10,000 beds. So that is around 70% increase in bed capacity this year. And we think that this will be a major revenue and profits driver for this year itself. I will explain more in the next slide. For the next segment itself, property development segment, they develop and sell residential and industrial properties. Currently, the developments for sale is Bartley View, which is a 115 unit residential property, and Mega at Woodlands, which is a 517 unit industrial property. So currently, for both of these property itself, 90% of their units are already being sold out. So Bartley View, 91% is being sold out already. Mega at Woodlands, 97% is being sold out already. So management is optimistic to sell most of the remaining units by end of FY24. And we do think that the revenue for this segment will gradually decline because there's only a limited amount of units to be sold. As for the fund management and PBSA operations, as you can see, they contribute very little to their revenue. However, WeHer is able to capitalize on selling the entire stake of the property itself. Within fund management itself, there's two funds. One is Fund 1, one is Fund 2. And both funds hold PBSA properties itself. And WeHer recently sold 37.1% stake in Fund 1. And they experienced a one-off gain of around $36 million. So because of this one-off gain from sale, we do expect special dividends from this sale itself because they will have quite a lot of net cash after this sale. The net cash will become close to 70% of their market cap, which is very significant. And because of their track record of last time they have issued before special dividends after a good financial performance. So we do think that they may issue special dividends again from this sale itself. As for Fund 2, they are still holding it. Fund 2 will be operational this year, starting from the first semester of 2025. Yep. We initiate coverage for WeHer with a buy recommendation and target price of 0.62, which is around 40% upside. Next slide, please. Yep. So I'll be talking about the worker dormitory segment for WeHer. We do think that this is a very major growth driver because of the 70% increase in bed capacity as mentioned just now. This new worker dormitory called Pioneer Lodge, is expected to be partially operational by first quarter this year and fully operational by the end of this year. As you can see in this chart, the revenue and operating profits is expected to experience a gain in FY24 because there's a very significant jump in rental rates in FY24 because of the high demand for worker dormitory. Within the first half FY24 itself, the jump in revenue and profits is already for 68% year on year. Yeah, so we do expect a jump in FY24. As for FY25, we think that the major growth driver will be coming from the new increase in bed capacity itself from Pioneer Lodge. So in totality, from FY23 to FY25, we do expect to see a 40% CAGR within this segment itself in revenue and profits. And because worker dormitory takes up a big portion of the entire group segment, revenue segments of around 40% as shown just now, we do think that this will be a significant growth driver for WeHer in the coming years. Yep. So that's it for WeHer. Right now I'll close off this segment of our presentation. 2024 was a memorable year So Singapore markets was up by 17% in 2024, and it almost reached the all-time high, which is only around 2% shy of the all-time high achieved in October 2007. Navigating 2025 will be daunting because there's a lot of unpredictable policies from the new US administration. And for 2025, we do see three key themes. The first one is lower rates. We think that there will be 4 rate cuts in 2025. Second theme is China's re-rating. We are not expecting a very strong rebound in China's growth. The last but not least, the third theme is corporate restructuring. We think that restructuring of corporate assets via public offerings or stake sale will drive alpha, which means that we think that it may generate returns higher than the benchmark itself. Yeah. So that's all for our presentation. We can move on to Q&A. Yeah. I think I can take the first question. I saw earlier on soy build. Okay, so the question for soy build is soy build construction's price has multiplied more than 10 times recently due to being awarded the contract for construction of Tuas Port for 640 million. Will there be further upside? Yeah. So just to clarify, soy build recently did a stock split of 10 stock split to 1 stock. So that's why the stock price has multiplied by around 2 to 3 times, from 0.3 to the high of $1 plus, $1.01. But then recently it's dropped back down to 0.8 cents. So I see where the confusion comes from. It has not multiplied for more than 10 times. Rather, it has multiplied by around 2 to 3 times. Yeah, just to clarify. Okay, so the question is, will there be any further upsides apart from this Tuas Port construction contract? We don't cover soy build. However, we did go for their analyst briefing. So for soy build itself, currently their annual revenue is around 200 to 300 million. However, management did guide that because of this huge Tuas Port contract, it can reach around 400 to 500 million. So I think that's quite a huge jump. It is around a 30 to 50% jump in revenue. And recently they have also completed all pre-COVID loss-making contracts. So they also guided that margins should be stable going forward. With regards to whether I think there's further upside, at least for the next 3 years, I think there's upside in revenue and profits because this particular Tuas Port contract will take 3 years to complete. So I think for the next 2 or 3 years, there will be quite a lot of upside in revenue and profits. And I think other upsides will also come from the elevated levels of construction contracts being available in the market because of this strong demand of construction projects being available. We do think that this is a major tailwind for soy build as well because they directly take in the construction contracts and they will generate revenue and profits from there. And they also guided that going forward, there will be more contracts for advanced manufacturing facilities being brought in by EDB, so Economic Development Board. Yeah, so EDB will actually bring in more overseas contracts into Singapore because Singapore wants to be an advanced manufacturing hub. So this is the story that soy build is trying to sell, that their main source of demand will come from there. And because of this, I do think that there will be further upside for soy build itself. Yeah. I think for now, I'll hand over the time to my other colleagues first. Yeah. Thanks.
Hey, thanks, Iqbal. Yeah, let me take a bit of the questions. I saw some banking questions. Okay, Glenn, your overweight on the 3 local bank, what time frame of overweight looking at the whole year? Yes, so but we just to note that we also do adjust our call, as and when the news comes out, or if there's any based on the results as well, right? So we do adjust it, but as of now, yeah, we have a 1 year, I think it's a 1 year time frame for the calls that we give out. Yep, so that's what we're looking at least, now's the start of the year, we're looking at for the 2025, we are overweight for the banking sector. And of course for the overweight on the 3 local banks as well for the whole of 2025. I mean, due to the multiple reasons that I said earlier. mainly the fee income, loans growth recovery, net interest income, and margins being stable. Yeah, those are the three big reasons that we have. And also, last but not least, the high capital ratios and excess capital that the banks have. So that's one of the things that I think a lot of the investors will be very interested in, because it is directly impacting how much dividends you're getting. Yeah. Okay, there's an interesting question here. Hi Glenn, credit card rollover balance hit a record high as reported in the news. Will this have an impact on Singapore banks? Thanks. Yeah, I did read this article. Right, I think it's by Straits Times. If anyone's interested to go and read up on it. Yeah, as usual with I don't want to blast Straits Times or anything, but as usual, to get readers to read this, they have to put a very not controversial, but it's a very loud statement out there. So I think that the title, if I'm not wrong, was like credit card rollover balance at record high, right? And it looks like, whoa, it sounds like bad news. But if you dig deeper into the article and into the banking sector, you realize that yes, well, it is sort of a record high, but if you look at the other segments of this credit card, they call it rollover balance. The other segments, like credit card, debt, NPLs, it's not really that high, because it's coming off a low from COVID times, and now we're just going back towards pre-pandemic levels. It is similarly to the bank's credit costs, as well as their NPAs, non-performing assets, and their NPLs, non-performing loans. So all these have crept back up, but it's only just going back to what it was before the pandemic. So we're just going back to a more normalized area, normalized time. So if you look at everything in a whole, right, you also see, if you read all the way down to the second part of the article, you realize that the bank's comments are all very similar, right? It's that yes, it has gone up, but it's only just back to a normalized kind of area. If you look at, more importantly, look at the bad debt, you look at NPLs and NPAs, it's also quite okay, because it's just it is increased, but it's still at a low, right? To them, it's still acceptable. So I think that's the more important thing, is to see that as long as the credit costs and the NPLs haven't gone up drastically above what we have seen pre-pandemic, because now we are going more into a normalized kind of period, and then there's nothing much to worry as of now. So we just have to keep a watch for these figures. But from looking at it, the credit costs haven't gone up, provisions haven't really gone up drastically. So the banks are also quite satisfied with this. And I think one of the other factors, one of the other things that I read that was quite useful in terms of the macro thing, is that they're seeing also the unemployment rate, at least for Singapore. So unemployment rate is at the low. So as long as unemployment rate is at low, means that the people who are taking on this credit card debt, so-called, or like they're rolling over, it might just be that at least they still have a jobs or pay to come in to offset the debt, right? You'll be worrying if, let's say, unemployment inches up and they are unable to pay off their debt. Then that's where the worry comes in. So I think it's a lot of factors, not just that one figure we look at and say, oh no, the banks are going to be hurt because of possible bad debt. Yeah. So I hope that answers your question and sort of clarifies this kind of like headline news that I like to call it. Okay, so next one here, yeah, this is a good question. So I think I was expecting this, mainly asking, does DBS have any individual merit versus OCBC and UOB, because it's not in the topic model. Yeah, as I mentioned earlier, we like to find the picks in our portfolio, that there's like more upside to the share price, and also that makes it stand out differently from the others. For DBS, it's definitely I mean, the share price firstly has gone up quite a bit, right, in the last few quarters. Yeah, it surpassed the other two banks. So we believe, even if with our target price, we believe that there's not much more room to grow for DBS as compared to UOB and OCBC. So is it still strong? Yes, we believe that it's still strong. We still have an accumulate call on DBS. For the individual merits, now how do they differentiate themselves from the other two banks? Firstly, they are very open, right, with what they're going to be doing with their capital. Right, they really said, we're going to give you, they committed to this 54 cents increase per year in dividends, and they're going to commit to it. So even when asked in the last results, which was about two months ago, they said that, yeah, even if we go past the dividend payout ratio of 50%, we will still commit to this, because this is what we have said, right? And they've also mentioned, that they're doing share buybacks of 3 billion. So in terms of they don't really have any surprise per se. If you look at DBS, they really lay everything out on the table, and investors have reacted positively to it. This year being the increase, including dividends, share price has gone up by almost 51%, right? So that's why we believe there's not much more upside to DBS's share price. Apart from that, DBS is also quite strong because they do have the largest amount of excess deposits as compared to the other two banks, right? Maybe it's because of them being a household name and they're the biggest in Singapore. So Singaporeans love to just put money with DBS, even though it's like in their current accounts, they're not earning much interest, but they just like to put it there because of maybe it's a safety. They believe that it's stronger, bigger. So that's the reason why we believe that their net interest income will also be quite stable, where they're able to roll over more of their excess deposits into interest earning assets like treasuries and maybe other kind of deposits where they can earn their interest. So their net interest income is really quite protected, more protected, at least compared to the other two banks. Yeah. Okay, let me just scroll down. I think I do have a few more questions. Let me just try to take them on before I pass it to the rest. There's one about HSBC being SGX listed. I don't think it's SGX. I can't find, if you just point me to where is it SGX listed, but I don't think it's SGX. HSBC is not SGX listed. I don't think I can answer this question. Yeah. So okay, about the China banks, we don't cover China banks, so really hard for us to get a reply to this. I'll try to find a reply maybe from our Hong Kong team, see what they can say. If anything, you can always join there's also a strategy and stock picks for the Hong Kong side. You can ask them this question. I think they'll be able to answer it better, or more accurately at least. Yep, so for those, the 4 counters under the asset monetization theme, right? I'm just covering for Paul, so I'm not sure if I can answer really any of the questions that come in. I don't think my answer will be very accurate. So if you just put it there and I'll send it to Paul and he'll try to get back to you on the P3 app that we have here on the screen. You just scan the QR code, join the community and just put your questions there. And I think I'll ask Paul to reply. Oh, this one I can answer. They asked why is Singpost not covered by PSR? It's a 1.2 billion market cap. Yeah, so I will get back. I will ask Paul why is it not covered, and then see what he replies. I think there's one more banking question which I saw earlier. Okay, hi, Glenn. OCBC recently started to close all those accounts of foreigners who do not reside in Singapore, and many of the PRCs were forced to close the account. What is the magnitude like, and does it affect the DLR? I don't think, okay, so maybe it's not, I think this is more of a compliance issue where they are having to close their accounts for the PRCs. I don't think the magnitude is that big because it hasn't really affected it much. If anything, they are just really just protecting themselves by saying, okay, we don't want to get into any compliance issues with MAS. So that's why they have to close all these sort of like PRC accounts, because there is a possibility that there might be some money laundering AML issue or CDD issue. So that is probably one of the reasons why they are doing this. But I don't think they are closing all of it, right? Because from their perspective, how they're going to continue growing into 2025 is that they are trying to attract the money coming out of China and Hong Kong, right? So that's their main aim. So they are focusing on Greater China, Hong Kong, but they're not focusing in mainland China money. They are trying to get the money that is coming, the outgoing money, which is coming out. And that's how they are focusing their strategy, where they have this I think they call it the Greater China strategy, which is why they did the revamp about a year ago. So that's the reason why they're trying to do that. I think with this, maybe they're just doing some cleanup on their side to ensure that they are in line with compliance, AML sort of compliance matters with MAS. So I think it's a positive thing that they're doing this, because it shows that the bank is actually trying to work well within the legal reams. How to access P3? Someone asked. Yeah, we just need to scan this QR code here. you sign up a account for free, and then you can join the community, and then you can ask questions there. Yeah, okay, I'll hand it over to the rest of my colleagues. Thanks.
Yeah, I'm gonna take the Apple question first. So hi Helena, do you still hold an accumulated view for Apple in light of recent data point that China foreign phone sales sank? Well, Apple's trouble in China is really nothing new anymore. It's pretty much been the tone since the end of 2022. So if you do see their China, how they're doing for the China market, they have been seeing year-on-year decline almost constantly, which is trouble for them because China market is a really big market for them. It's a little bit slightly less than 20%. So for the entire 2024, we have been trying to keep a very close look on the China market because it has obviously become a very obvious weakness for China. For Apple. So new phone rollout, it doesn't really woo the crowd, and their competitors are coming out with a lot more new features, revolutionary. Apple did came out with Apple Intelligence, but that doesn't apply in China because you're not allowed to use even with the full rollout of Apple Intelligence. It doesn't apply to China. So to be honest, for the China customers, they really don't see much in the short term in terms of Apple. So this is the first time where the new model came out. Immediately you see the phones selling on discount. And I think recently they also have a 4-day sale, which is also very, very rare for Apple. We did see a slight spark in the China market by the end of 2024. I think that is when the new iOS system roll out and people kind of curious and want to test out what it is. But there's not much splash afterwards. It kind of died down really fast. So for Apple right now, we think we're really at a crossroad here. So it really depends on the rollout of the Apple Intelligence features, how accepted people will be about the features, and how viral it will actually become. I think overall we're still rather optimistic in the rollout because it is obviously a very grand plan that requires a lot of time and effort for them to actually develop. So while they're falling behind in terms of the hardware compared to their competitors, it is really because they're doubling down on their software development. So I guess that is what Apple is known to do, right? To create an entirely different and revolutionary ecosystem, and that's totally unique compared to others. And hopefully it will gain popularity among people. So they're still at the very beginning of the rollout. So we'll be seeing more of that in 2024. So overall, in terms of the entire market, we're quite optimistic. But yes, I'm not gonna lie, the China market is constantly gonna be a problem for them, at least in the short run, because it's not even gonna roll out in China at all. So I hope that answers your question. I guess that's all from me. I saw someone else asking, there's no sharing for the US market. Yes, so today is really a quick recap of the Singapore SSP. So if you're interested in the US market, we actually have US SSP coming up in this week. So you can keep a close lookout on that. That's pretty much on my side. I'll pass my time to my colleagues.
Yep, let me take on some any upside for prime US REIT if not to cut loss. Yeah, so for prime US REIT, we do think there is some upside, but in the near term there will be still some weakness, mainly because of the worries surrounding the asset revaluation exercise. So our target price is 20 cents, but for prime US REIT, now it's trading at a steep discount to valuations. Is almost over 75% discount to valuations. So that's one of the reasons we think that there is a potential for recovery. Fact that they're trading at such a steep discount to valuation, that's one. And also the further interest rate cuts will likely improve the sentiment in the market as well. I mean, even though not so soon, we do expect property valuations to slowly start to increase towards the second half of 2025 and perhaps or 2026. So we do expect some property valuations there, and you do expect market sentiment to turn around with the slight the interest rate cuts as well. So we do think there is upside potential for prime US REIT, but it's more of a growth story than a dividend yield perspective. Because dividend yield wise, we think they might just continue paying that 2% dividend yield, just a 10% of their distributable income. But we see some growth potential over the next in the longer term. So not so much near term, because near term there still are some headwinds from the weak leasing and the fact that we still do expect some devaluation at this year end valuation exercise. But in the longer term, like over 2-3 years, we do some recovery potential for prime US REIT share price. Like just to reiterate that they are trading at like 0.25 times price to NAV, so that is huge discount. Any fundamental reason why REITs rebounded start of the year after sell-down post FOMC? Yeah, just this past 5 days, I don't see any specific reason. I just think that it's more of market volatility that the REITs rebounded. Yeah, no particular reason in these 5 days. Yeah, but the REITs, the share price really towards the end of 2024, it just really got sold down in the last month of 2024. Yeah. What is cap rate compression? So cap rate compression is okay. So cap rate is actually net property operating income, or rather the NPI divided by the asset valuation of the property. So when interest rates come down, that when we say cap rate compression, we mean that this ratio will likely decrease. So when this decrease, basically it means that the denominator will be bigger. So when the denominator expands, basically that means that the property valuation, which is the denominator, will be more, which means the valuations will increase. Yeah, so that is the opposite of cap rate expansion. When the cap rate expansion happens, that means the property valuations will decrease. Yeah, so that is cap rate compression. Yeah, do you feel some of your REIT coverage, Land Lease, Suntech, OEE, Elite Prime, will have danger of breaching the limits? Yeah, so from my perspective, just now when I was doing the presentation, I had that table. So with the new relaxed limits, we don't think there is the risks of them breaching are high. But our Prime US REIT is the one that we think the gearing is almost 50%. So that one we have to monitor. But for the rest, we don't think that they will breach the 1.5 times ICR, as most of them, their gearing is in a safe space. But most of the REITs that you mentioned there are covered by Meow. So I'll just leave this question there to see if she has any more comments for those particular REITs. Yeah, what is the significance of PERPS bonds reset date? Yeah, so for the PERPS bonds reset date, that I put up in the table as well. Land Lease and Suntech have PERPS that are expiring this year. So what the significance of that is that if they refinance, or rather they decide to call back these PERPS. So when they call back the PERPS, right, then they either issue new PERPS, or if they call back these PERPS and they issue new bonds to refinance these PERPS on the call date, then their gearing will increase, because PERPS is more of a pseudo equity instrument, so they are not calculated in gearing. So if the REITs, they do decide to call back and issue new loans, or rather take on more loans, or issue the normal bonds and not PERPS to refinance these perpetual bonds, then their gearing will likely increase. So that is a factor that we are looking out for. Yeah. So that is a significance of the PERPS reset date. Please comment Manulife US REIT given its current status and likely development going forward. Yeah, so for Manulife US REIT, the thing they need to do now is to divest another 200 plus million US dollars worth of property by June 2025. If not, they'll breach the so-called the recapitalization plans, because they have to pay a penalty if they do not divest 200 million more. Because by June 2025, they are supposed to divest, if I remember correctly off the top of my head, it's 328 million worth. They've divested capital, so that's about 100 million, and they have another 200 plus remaining. So they also had some requirements to, if I'm not wrong, by end of last year, they were supposed to divest 200 million, and they didn't manage to. So as a result, they would have incurred a bit of penalty for that. If I remember off the top of my head, it's a couple of $1 million. So that will likely be seen inside their full year 2024 results as well. So yeah, that is a penalty as they did not manage to divest. So that is the key priority for them. They have to basically divest this more 200 plus million Yeah, and then over time they will have to pay off their debt because their debt is also yeah, it's also expiring, even though it has been extended by 1 year due to this recapitalization plan. Yeah, so that is likely developments for them. The key priority is asset divestments. So by first half 2024, another 200 million minimum. Do you expect good take-up rate for Ori Toa Payoh? Yeah, so for Ori Toa Payoh, over the past week, we saw some very, very strong demand. If I'm not wrong, there's some articles that said there were over 8,000 people who went to view that property, and this is it is along Toa Payoh, and it's the first private residential launch also in Toa Payoh since 2016. So I do think demand might be quite strong for that, and I do expect some good take-up rate for this particular launch. Yeah, so we'll see, but yeah, from what we saw over the preview the past few days, yeah, the from Jan 3rd to Jan 5th, yeah, 8,000 over visitors. And got any target price for Keppel DC? Given Microsoft's announcement on data center and Keppel DC slow dividend yield. Yeah, so for Keppel DC, our target price is $2.16. So that is below the current share price. So our reason is mainly because okay, like Glenn mentioned in his slides at Keppel DC, that Keppel, the data center is a strong point, but that is mainly only for those assets in Singapore, the co-location data centers in Singapore. So the overseas assets like for Keppel DC REIT, they still have some issues in China. They're not collecting rent from China still. And other than that, they still have some leases that are expiring. So there is some vacancies there expected, and the main overhang for Keppel DC and our target price of 214 is because of the recent acquisition as well. So the recent acquisition was the acquisition of Keppel DC 7 and 8, which cost almost $1.5 billion. So this cost, because it's such a huge sum, they had to do an EFR, and they had some private placement and preferential offering. So in total, it's more than 15% of new shares that started trading in the market since the acquisition, since they raised those funds. And we expect there'll be some overhang as some of these entities start selling, as there are a lot of new shares in the market. Yeah, so these new shares in the market we think is a overhang for Keppel DC in the near term. And the fact that they are still trading at about 4% yield, yeah, we don't think that is very attractive for REITs right now. Because right now for REITs, our play is more of a high yield dividend yield strategy. Yeah, so that is our take for Keppel DC for now. That's why at $2.14 target price, that is a neutral call. Do you have any recommendations for CICT? Yeah, we don't cover CICT, so we do not have any recommendations. Yeah, but CICT, their portfolio is strong. Yeah, their retail presence one of the strongest in Singapore, and their office as well. Yeah. And for REITs, we do favor the retail sector now because we think there is room for positive rent reversions from higher population and improving international visitor arrivals as well. And the fact that a lot of overseas brands, retailers, they are trying to enter Singapore, and as well as like overseas food concepts as well. Like this recently, over the past few quarters, there was this huge boom in Chinese hot pot, F&B hot pot. So yeah, that also really increased the demand, that tenants increase the demand for retail space, as well as the fact that retail space is also upcoming supply is also relatively limited as compared to the historical averages. Yeah, so all these are strong factors for retail. So CICT will benefit from that. Yeah, there's a question on Keppel DC, recommendation neutral, even though data centers in high demand. Yeah, so I think I went through that already. it is definitely a secular trend that data centers will be high demand for this generative AI demand. Yeah, but there are still some near-term headwinds for them for Capital DC. Like I mentioned, the overhang in the private placement shares, as well as the non-collection of income from China. So that accounts for about 10%. So that is also not great news. Yeah, so we think and also the fact that they are trading at like 1.6 times price to book. So if you remember back then 2020, if I remember correctly, Capital DC also there was this a huge boom where the REIT started trading at like 2 times price to NAV. Yeah, we don't think that situation will likely happen again. Yeah. Why is CapitaLand has got why is CapitaLand has got a stock pick when hospitality REITs are not expected to perform well in 2025? Yeah, so for hospitality REITs, we do expect RevPAR to continue to slow, as we saw RevPAR in 2024 is slowed to since from the high base in 2023. Yeah, but for Class, right, specifically because of their good track record in their inorganic growth potential, like they've divested many assets at good yield, and they locked in a lot of divestment gains as well, so that will benefit them. And because of their geographically diversified portfolio as well, in Singapore, we see RevPAR growth not so great in 2025, especially since 2024 was such a stellar year. Like in first quarter, there was so many major concerts, Taylor Swift, Coldplay, Ed Sheeran. Yeah, so this first quarter 25 will be weaker than first quarter 24, definitely in our view. But there are still some strong signs in hospitality in Singapore, especially like the Minion Land in USS and the Sea Oceanarium, as well as the World Aquatics competition as well in June. Yeah, so all these will help to boost RevPAR numbers in Singapore. But basically for Class, because of their geographically diversified portfolio, some of their stronger assets like in Japan will help to offset perhaps the weaker market in Singapore. So it's a very balanced play for Class. But we do expect RevPAR to trend back towards a pre-COVID level growth, which is low to mid-single digits going forward. So we still do expect growth over the course of the year, but first quarter will be challenging for Singapore specifically. Capital DC REIT again, does it have growth story for 2025? Yeah, so for growth story, our view is just Singapore co-location assets. Yeah, but other than that, we think not much growth for Capital DC in our view in 2025, other than the very strong co-location demand in Singapore from the limited supply. So we do expect some strong rental reversions there in Singapore. Yeah, but overseas, not so. Yeah, so there's a question directed to Glenn. Capital is a buy from you due to demand of data centers, but earlier comment on Capital DC is a neutral. Yeah, so the demand for data center is still there, so Capital benefits from that. But like I mentioned, Capital DC, they have their own set of issues like the private placement overhang and the China side. Yeah, so these are the weakness. Yeah, I already mentioned that, so I'm not going to repeat that again. Yeah. CFA ETF. CFA ETF, if I'm not wrong, that is the Nikko AM REIT ETF. Yeah, appears to have cut its dividend. Is that right? Yeah, I'm not sure. So maybe Helena, you can answer that. But let me see. Do you see more cuts and price drop? I thought it would be a good proxy for REITs that are buying individual counters. Yeah, definitely it is a good proxy to the REITs to just invest in the index. If you do not want to pick stocks individually, yeah, definitely it's a good proxy. Yeah, but the thing is, if you if you focus on more individual counters, you have to monitor the REIT specifically. But if you just want some REIT exposure, yeah, the CFA or rather the Nikko EM ETF might be a good option. Yeah, but yeah, from my view, they appears you mentioned that they appears to have cut its dividends, yeah, mainly because basically 2024, 2023 high interest rates, so as a result, dividends were affected. So I would think that the REITs, the ETF would also cut its dividends. Yeah. I'm not sure if Helen have anything to add for that, so I'll just leave the question there. Yeah, a lot of questions on WeHer. uh, which retail REITs do you prefer? Yeah, so for retail, prefer FCT because we think suburban malls are more resilient. Yeah, but yeah, basically for retail REITs, the only pure play one that we see that we cover rather is FCT. So we also like FCT because of their suburban exposure. So population growth for this um will help to improve their tenant sales. But for those retail malls with those downtown areas, we still see some strong positive rental reversions, but the fact that tenant sales are quite weak, especially from the fact that a lot of tourists, they are spending less. There is a little bit of down trading trend. Yeah, so we're not so sure how long the double-digit rental reversions can continue, but we still think that there is potential for at least a low teens rental reversions for downtown malls. But for suburban malls, we still see rental reversions to remain rather resilient. Yeah, so we think yeah, we prefer FCT. Yeah, Darren, can you repeat your reasoning for price spike for REITs post FOMC? Yeah, so I'm not sure if you are referring to the FOMC meeting, the December one. Yeah, because I don't think the price really spiked then. But yeah, I don't really see much specific micro reasons or any specific reasons why the REIT share price recovered at the start of the year over the past 5 years. I think it's just the usual volatility as the end of 2024 REITs were sold down. So yeah, I guess people started buying back as they thought it was cheap after the sell down. Yeah, ESR logos performance 2024, any upside? Yeah, I don't really follow ESR logos, so yeah, I can't really comment on that. Yeah, even if I comment also might not be right. So yeah, better not. So I won't comment on that. Yeah. I think that's all for me. I'll hand over back to whoever wants to pick up the questions. Thanks.
Thanks, Darren. I'll take the rest of the risk question. For Lendlease, Suntec, OUE, and Elite, the danger of freeing the limit. For Lendlease, we do believe they will breach ICR of 1.5 times this year. It's just a matter of time. Yeah, so gearing is likely to be capped at 45%, and currently gearing is 40.7%. And with like 306 million bank loan and 200 million and perpetual securities maturing this year. Yeah, we believe yeah, the only solution, the only way out will be for Lendlease to divest something. Yeah, so GEM will be the top option. Yeah, but currently it's just pretty hard to find a buyer to divest at the price above or at least like on par with the valuation of 440 million, 450 million. Yeah, and for Suntec should be okay. Suntec, OE, and Elite, we think should be okay for them. Less likely they'll breach the gearing this year, since all of them has divestment plan. Suntec is divesting Strata units, currently divested 15 million of the Strata units, and targeting 100 million by the end of this calendar year, which they'll announce like in this February, I think. And OUE just divested Lipo Plaza in Shanghai. Yeah, so they'll use all the proceeds to pay down the debt. Yeah, so they'll be having lower interest expense this year. And Elite is also divesting some of their vacant asset and use it to repay its debt. Yeah, so and their interest rate already peaked this financial year. Yeah, so we believe they'll also be safe. And yeah, next one. We have a neutral rating on SIA. How does this impact sets in 2025? Is it neutral or buy? So we have a reduced rating for SIA, essentially because like the spread between unit cost and unit revenue is falling. Yeah, so meaning the margin has been compressing. And also their operating metrics are deteriorating, like their load factor and yield has been kept contracting from the high last year. Yeah, and costs are rising essentially is because of the inflationary pressure. And one of the big reason is sets just repressed SIA. And we believe the new price will at least increase by 5 times compared to the previous contract. Yeah, so we still have a buy for sets. And sets revenue has been mainly supported by the cargo handling side, which SIA has been benefiting from it as well. But it's just small fraction of the SIA's overall business. So it doesn't really support the overall performance. Yeah, so in short, we still have a buy rating for sets, at least before the implementation of the US-China tariff. There is a question for Zixing. Wait, let me find it. Zixing, what's your take on the chicken feed pattern news? How much does it affect the bottom line? Yeah, so the pattern is pretty important. It's definitely a revenue catalyst, and it gives some higher margin for their for their animal feed segment, and it's around 30%. Yeah, which is much higher than the general market. And compared to their competitors, Zixin does have its proprietary probiotics formula added into the animal feed, which helps to reduce the hormone level and also the antibiotics yeah, inside the animal's body. Yeah, so this will improve like the meat quality. Yeah, so they do have higher margin for their animal feed. And we anticipate Zixin will generate 1.2 million revenue in this financial year, which has already kicked in. Yeah, so it's for fourth quarter 25. And next year should be around 10 million. Yeah, in their 10 million in their revenue and generating around 1.7 million for their pet meat. Yeah, hope it answers your question. I'll hand over to Ben probably. Yeah, thank you.
Yeah, thanks, Mel. Take some questions. Okay, the first question for me is any outlook for NVIDIA AMD ahead of CES this week? Yeah, so for context for the rest who don't know, CES is a big tech exhibition event held in US. So many major tech companies will be there to present their products. So for NVIDIA and AMD, I think they'll be trying to talk about their AI products. For NVIDIA itself, I think they will try to sell their how good their Blackwell GPU is compared to its competitors. And I think for AMD itself, they will also try to sell their MI300X GPU and also talk about how they are gaining PC share versus Intel, because I think their Zen 5 CPU processors are also a major talking point for those interested in tech. Based on their historical performance following the CES event, right? I took a look at 2023 and 2024 performance. After the CES itself, the share price for NVIDIA will rise by about 2 to 3%. So it's a minor gain. But I would disencourage investors to speculate based on this event itself. I think the bigger growth driver for Nvidia and AMD will be Trump coming into office, because I think he will talk about imposing tariffs on China, and I think that will have a bigger impact on their share price itself. Yeah, that's my personal take. Okay, I think there's quite a lot of questions on WeHer. Yeah. Okay, so there's a question, Tim, what is your view on construction sectors for 2025? Yeah, so for 2025, Changi Airport Terminal 5 will begin the construction. We do think that construction awarded will also rise as well. The payments being taken in terms of revenue and profits will rise as well, as presented in the chart earlier. Yeah, so we are quite positive on the construction sector for 2025. Any views on Sembcorp? Sembcorp is being covered by Paul, so I think it's better if you refer this question into our P3 community chat group to him, then he can answer from there. Iqbal, what building construction projects does WeHer receive? Do they get the mega government contracts like Changi Airport Terminal 5? Short answer is no. WeHer's construction projects currently, there's 4 major ones. First one is Bartley Beacon. It is a public housing BTO project. Second one is a funeral parlor complex at Mount Vernon. And last 2 construction project is the Bartley View, which is the residential property, and also Pioneer Lodge, which is the worker dorms project, because they actually built the worker dorms themselves. Yeah, so these are the 4 construction projects that they are currently handling. So they do not take in the Changi Airport Terminal 5 mega contracts. Yeah. Next question for WeHer, is there an approximate timeline for the special dividends to be declared and paid out? Just to clarify, the special dividends is not a confirmed thing. It's just based on my personal views, because based on their track record, they actually did pay out special dividends after a good financial performance. So we really don't know when they will pay out we really don't know if there will actually be a special dividends, and we don't know what's the approximate timeline. But if I have to make a guess, the contracts is expected to complete by first half this year. So I think the special dividends will follow after that. So maybe it will be the end of the first half this year or the second half of this year. Yeah. Next question. Ben, your positive outlook on worker dorm per sharing on WeHer. What about Centurion and others? Yep. So based on my positive outlook for worker dorms on WeHer, I think it is a very stock specific view, because this new worker dorms itself will actually add a significant 70% bed capacity in WeHer itself. So that is a very major growth driver for WeHer, but it is specific to WeHer itself. Yeah. So I do think that supply of worker dorms has caught up with demand. So I think that rental rates will moderate going into FY25. So I don't think that worker dorms rental rates can be a growth driver for worker dormitory stocks. However, for Centurion, there is a specific growth driver for them, which is that they are going to have a new worker dorms as well, called Westside Ubi. It is going to be 1,650 bed worker dorms, which will add about 5% bed capacity to Centurion. Because Centurion currently has 32,000 beds. So adding this 1.6K beds will not actually will be a growth driver, but it will not be as significant as WeHer itself, because WeHer's current bed capacity is 16,000. And this year itself, they will add another 10,000 itself. Yeah, so the scale of growth in bed capacity is different between WeHer and Centurion. As for the others are quite small players. Yeah, so yeah, mainly our coverage is on WeHer and Centurion. Yeah. Next question, will WeHer be looking to monetize or unlock more value from their assets? That will be a nice catalyst following the Fund 1 sale. Yeah, I do agree that for PBSA itself, they have another fund called Fund 2. I do agree that if they are able to unlock more value from their Fund 2, from selling their Fund 2, you'll bring in a major catalyst for the stock as well. However, I do think that there is some track record needed in for Fund 2 itself before they can actually sell this asset. Because for Fund 1 itself, the PBSA actually have a few years of track record of good occupancy rates and yeah. So I think that's a major selling point in which why they are able to sell at a gain for these properties itself. So for Fund 2, it just became operational. It will just become operational this year. So I think that there still needs some time for the track record to come in before they can actually sell the Fund 2. Yeah. So I don't think it will be in the near term that they can actually unlock more value. Yeah. Next question, is WeHer or Centurion the bigger player in the PBSA space? Short answer, currently WeHer is the bigger player. WeHer has around 6,000 bids in total within the Australia PBSA. Centurion has about 900 bids in the Australia PBSA space. Yeah. So for if you talk about in terms of bids, WeHer is the bigger player. WeHer only has bids in Australia, whereas Centurion has bids in UK as well. UK itself, they have around 2,800 bids. However, if you add up to UK bids and Australia bids, it's still less than WeHer's stake in terms of bid numbers. Yeah. So hope that answers your question. There's a question. Are you positive on Tiongwoon? Sorry, we don't cover Tiongwoon, and I didn't really read up on them, so can't really give a view on Tiongwoon. Yeah. Hopefully, if you can direct this question to my email or P3 community group, then I can read up on it and answer the question for you. Yeah. When EHER EGM, that one I don't have a specific date as well. Yeah, I think we will have to wait for their announcements for their EGM date. I think that's all for my end. I can hand over to my other colleagues. Thanks.
Yeah. Thanks, Iqbal. I think I can move on to share a bit of to do a bit of a TA on the TA related questions. So I'll just share my screen right now. Yeah, I'll begin with the Singapore and Hong Kong questions. Then if time permits, I'll do a bit of the US. So I think the first question I see is regarding WeHer. So for WeHer's chart, I think for now I think we're still likely to see a bit of a consolidation because the price rebounded from this key support level around 41 cents. But for now, I will expect some sort of resistance around 46.5 cents, which is one level. And then the next resistance level is around 48.5 cents, which was this area over here before the price break down the support in the middle of December. So 46.5 cents to 48.5 cents, I will expect some resistance for now. And the stock is likely to do a bit of a consolidation for the time being. Yeah, that's my take on vehicle. Next one, CSE Global. Yeah, for CSE Global, in terms of the chart, I think that for now, yeah, recently there was this gap down over here. It went to retest the support around 40.5 cents, and then there's a bit of rebound. I will expect some resistance from this current level around 44 cents, which was this candlestick over here following the gap down, and that so this might pose a first resistance for now. Next one will be next resistance level upwards will be around 45 cents about there. So I'm also expecting some sort of sideways consolidation. Support level will be around 42 cents and resistance around 44 cents for the time being. For CSE Global. Next one is on SETS. And for sets, I think for now, the chart there's a bit of a there's been a bit of weakness ongoing since November, where we had this breakdown over here of below 390, and then mid-December there's also this breakdown below 370. So for now, I will expect support level at this around 355 to still hold, which is this quite a strong support level over here, but resistance to come in at around this 370 breakdown level. So also a bit of range consolidation there. And also a near-term support level above 355 will be around 362, 363 over here as well. Well, I'm also expecting some consolidation first for sets currently. Next question. Next question is on Sembcorp Industries. Yep. So for Sembcorp, I think for now is also in a bit of a sideways consolidation phase currently. Because but overall for now I'm still more towards an upside bias for Sembcorp because we see a higher highs, higher lows since the short-term reversal that took place end of November. Yeah, for now, resistance around 557, this breakdown level here, but I expect stock to consolidate at a higher low, support levels around 547 as well as 550 around there. Yeah, then if it breaks up this 560 again, it's likely to retest its swing high around 568 to 570. Yeah. That's for Sembcorp. Next question is on Keppel Corp. Keppel Limited, sorry. Yeah, for Keppel, I think the chart is still quite bullish because recently it recovered a bit above this breakdown level around 678, and then today there's a break above this resistance around 690, which has been holding since start of December. So I think it's likely to actually move up higher in the near term towards the next resistance around $7 to about 710, that region, I guess. Yeah. But I think for Keppel, it still looks quite bullish for now. Then the next question is on Jaffa. For Jaffa, I think the overall trend is still very strong and healthy. We see over here just a series of higher highs and higher lows with some bullish consolidation along the way. So for now, some resistance in the past, this was 2021 levels, was back over here around 45.5 cents, and then the next level is around 48 cents, followed by around 50 cents. So currently, encounter a bit of a resistance, but I will expect a similar kind of price action as we've seen since October. It's likely to do a bit of a sideways consolidation. I would guess probably between 44 cents to maybe 48 cents around there. Then if it breaks above the highs again, then we are likely to see some sort of bullish trend continuation go on for Jaffa. Next one is AEM. Yeah, for AEM, I think there's some interesting chart because there's a bit of a reversal taking place for now because managed to break above this resistance at 145 as well as this resistance over here at 150. So I will expect some near-term momentum upwards to actually try to fill these two gaps over here during the previous sell down that took place in August last year. So currently, yeah, I'll expect price to try to test like 165. Then the next level that it could go up towards is maybe like 173, 174 about that. Yeah. So I think as long as further retracements in future, as long as it holds this 145 level, then I think we could be seeing a bit of a reversal taking place. Yeah, since there's been some consolidation ongoing. So next one is Franken. So for Franken, also a bit of a recovery for now. Looks like it's also positive as well because previously there was a breakdown below this support level about 116, 117. However, recently there was a recovery. So importantly is I think we need to see if it does backtest whether it holds this level. And if it can, I think we could see a bit of a slight upside to test the next resistance towards like 122, 123. Yeah. Then you might just do a bit of a sideways consolidation thereafter. I think I'll take two more. Since about close to one. Next question is on Keppel DC REIT. Yeah, for Keppel DC REIT, I think for now it's still likely to be in this consolidation phase, mainly between about 207 to about above $2.30. So I think just trading sideways. For now, I would expect price to maybe go up a little bit higher to test about 229. There's some resistance over there. Yeah, but support for now near terms about 220, 221 levels. So overall, big picture is still quite range bound since end September. And next one is Fraser's Logistics as a commercial trust. Yeah, so for FLCT, I think overall this is still one of the weaker REITs when you look at the chart. Just been downtrend since October. Recently, there's been a bit of a slight dead cat bounce to test the breakdown level around 90 cents level. So over here, I will expect some resistance to actually still act on over here, 90 cents level, then could do a bit of slight pullback. Short-term short-term support will likely hold around 88 cents. So I will expect a bit of a pullback to do some consolidation first. Yeah, for FLCT. Yeah, so I think that's all for the TA. Sorry, it's a bit short today. I think we have quite a bit of content and questions as well, but appreciate all your kind attention. Think feel free to join our the other webinars we have this week as well. I think on Thursday we have our US Treasury and Stock Picks event, and then on Friday there's a corporate insights webinar on by oil tech as well. So feel free to join. Then also, if you want more TA, there's tonight I'll be hosting a session on mostly focused on the US market and some of the indices and commodities as well. So if you're interested, feel free to join at 8 o'clock tonight. It will be 8 to 9:15. Yeah, so see you if you are free and interested to attend. Yeah, so I think on behalf of my team, I'll just close today's session, and thank you everyone again for attending, and I hope to see you all again next week. Yeah, bye bye. Thank you.